In Investing 101, we have Jennifer Freymark joining us now. She's with Edward Jones. Happy to have you here, Jen. And what's your view on market conditions?
Well, thank you for having me. Well, for market conditions, we believe that stocks are going to remain volatile, given that we've got the presidential election coming up in the next month. We've seen sharply rising oil prices, and also we've got some growing worries about various banks. These events will likely keep volatility elevated, at least in the short term, all playing a role in pushing stocks both up and down.
Do you think the market's ready for the election?
Yeah, we've got a big cloud hanging over us of uncertainty, and the markets don't like uncertainty. So once the elections are done, whether you vote for Hillary, you vote for Donald, whatever the outcome, it's going to be a positive for the market, and then we can get back to focusing on the fundamentals, such as earnings for companies, the economy, and also interest rates.
Okay, Jennifer, and what about historically? What do we know about the stock market and election?
Sure. Well, looking back historically, if we go back as far as the 1920s, there's only been 4 years that the market has not gone up after an election. And actually in the 2 months following election, we've seen an average of 3% from the election time till the end of the year for our average increase.
What's your forecast on the fourth quarter? Are you bullish or bearish here?
Well, again, markets remain fundamentally volatile, and we are more bullish. And for the third quarter, we actually saw the markets increase 3.5%, and we've had the first 3 quarters of the year up, plus the last quarter of last year. So historically, since going back to 1950, we've seen in 17 years where the markets have gone up, the first 3 quarters, 13 out of those 17 quarters have ended up with a fourth quarter where they've also seen markets go up, and it's been an average of 5.3% in those years where it did go up.
Do you think, though, that stock levels are too high at these current levels?
Good question. So while stocks are high, the S&P is high itself, the U.S. economy is actually producing more than ever. Our gross domestic product, our GDP, is high, and our second quarter earnings were better than expected. So we see that stocks could continue to rise as long as we're supported by continuing economic growth and earnings growth.
Are you bracing for another correction in the market?
Well, we're always bracing for a correction. We at times see the market drop as much as 10%, but we like to focus on the long term. So when we do see those pullbacks of 10% or more, that's a great buying opportunity.
Are you seeing signs of faltering, though, in the global economy?
Well, the global economy has been sluggish, so the rest of the developed world has remained sluggish, but the outlook may be improving as policymakers take additional steps, including lowering interest rates and also creating policies designed to accelerate growth.
And on that subject of interest rates, are rates too low?
Well, they're really too low for investors to count on income from interest rates, but they're actually not too low given our economic conditions. Assuming that our economic conditions do stay the same, then we should see interest rates remain low.
What is your overall prediction on the future? I know you don't have a crystal ball here, but what are you telling your clients?
Well, I tell my clients to focus on the long term and stick to their financial goals. And we're going to see ups and downs in the markets, but we take advantage of those downturns, buying quality stocks and bonds when we see pullbacks, and just be opportunistic and expect volatility.
Jennifer, a pleasure having you here. Thank you.
Thank you so much.